Okay, good evening, students. Hope you all are fine and hope you are working hard because these are last days. This is your trainer, SBR trainer, Mustafa Mirchawala from Mirchawala Hub of Accountancy. The objective of today's class is honestly motivation. Because I think I have recorded all latest past papers. Even I have posted it on YouTube. The last 4 sessions, last attempt I conducted complete past paper of latest September, December 21, which is the latest one, I think. And then before that, March, June 21 is already done. So all past papers we have already recorded. So the objective of today's class is motivation. Okay, because normally students, they are afraid of the paper. There is a fear of this paper. This is routine in every attempt. Let me show you something for your motivation. These are our institute's last attempt position. There are total 12. 10 is on the picture and 2 separate, Uganda top and Nepal top of F6. So out of these 12 positions, 9 positions came from my students and 3 SBR, 3 F6, 1 FA2, 1 F7 and 1 for F3, right? So out of these 3, the SBR positions are relevant for you. Out of these 3 SBR positions, this guy, Iraq top, Nasir Abbas, this lady Shibla, KSA top, these 2 were routine students. And you know, when they attempted the paper, when they came out of the examination room, they messaged me that maybe we won't be able to come up to your expectation. But I said, wait for the result. Wait for the result. That means when they attempted the paper, they were not sure they would clear this paper or not. Just think. And they scored the nationwide positions. So the fear is natural in this paper. Yes, it's a practical, it's advanced paper. New things comes in this exam. Even examiner says, and even examiner says you to write your suggested answer. You can't learn anything. You can't learn anything before the exam, then that you will do copy paste. No, it's not paper like that. And one special thing for you, this lady, this is Pakistan top of SBR. She scored 75. And remember one thing, that it's very difficult to score position in Pakistan and India because highly populated areas, and ACCA is very super hit in Pakistan and India. So big competition in Pakistan and India to score position. This is the practical thing I'm telling you. So this lady joined me in revision days. That means she didn't study anything before. She joined in revision days and she used this marking facility, what we mark, and she scored 75 marks. That's Pakistan top, highest marks in Pakistan. So when these people can do, why can't you? And one thing is natural. I repeatedly say this thing, that fear is natural. It is, and it is good. If it is not, then everybody will be a chartered accountant. Then there will be no value of chartered accountant, right? So it's better if they give you difficult paper, no issue. With these positions, I want to share some high scorers as well. Some high scorers, as you can see, these students, these are some students. I can't compile all the data because there are many students. So some students, those who routinely reply us and they send their data. So we have compiled their results. So you can also be part of this. Last time these guys were sitting in these revision days. Okay, so nothing is difficult. Concentrate on your writing skills. In these last days, do read a lot. Even read all the articles. Even in today's class, we have already done many past papers. So today I will focus on articles. I have pasted some cuttings of the articles, so that because I have observed that many students, they don't even read the articles, and articles are very important. That those articles which are available on ACCAglobal.com, they are relevant. Even in last time revision days, I was solving a question regarding ICO, initial coin offering. So I taught that question from the article of examiner, and believe me, complete copy paste of article came in 25 marks question. So if you read the article, you can score good. So it's better to read articles than doing the old approach of watching the lectures of IFRS and IAS and that's not beneficial, right? So better do more and more past papers, mock exams, article reading, right? And get it checked by your teachers. That's beneficial for you. Okay, so now let's move. In the beginning, I want to discuss something about the intangible asset, because you know, intangible asset is the hottest issue of the world, I would say. Why? If you see top 10 companies in the world in terms of market capitalization, they all are technology based. You see Apple company, you see Tesla, you see Google, you see Microsoft, you see Facebook, Netflix. These all FANG stocks, they all are technology based, and the major asset they have is intangible asset, right? Okay, so it is highly likely, I agree, that intangible asset looks like a very small standard as compared to financial instruments. Normally teachers, even I give a lot of time to financial instrument because it's a very detailed standard. Intangible asset looks very small standard, but to be very honest, if you see last few years past papers, we see a lot of weightage of intangible asset IS 38 there. Okay, so this cutting I have taken from September 2018. This is September 2018 past paper cutting, and somebody sent me this because maybe this was not part of my routine course. So one student requested me to discuss this. So that's why discussing this. Plus, I personally think this is important. That's why. Okay. So let's read it. This is the question and then the solution. So you will learn good things in it. And be very active. Be very active. Treat yourself as a winner. Treat yourself as a winner. Keep a wallpaper on your phone that SBR clear. Write your name and write SBR clear. I've done SBR. You know, I've seen many doctors when they do MBBS and they are still studying in the university, right? They are doing MBBS. Their parents call them with the name of doctor. So this gives a motivation that you are already a doctor, although they are doing MBBS. Now, our admin has sent a WhatsApp group link in the chat box. I would recommend you, all of you, to join that WhatsApp group because I will send many data on that WhatsApp group, okay, after the class. So till the last day of the course, it's very important that WhatsApp group, better you join it, okay? Now, external disclosure of information on intangible asset. Intangible is useful only insofar as it is understood and it is relevant to investors, right? You know, there is an article, and even last 2 years before or some, I discussed that article as well. Bin the clutter on the ACCAglobal.com. So in that article, this is also discussed that nowadays disclosures are too much. Disclosures are too much, and people don't have time. Investors don't have time. So if you give a lot of disclosure, that's also very bad. But yes, again, you must include relevant disclosures. Now, it is understood, and it is relevant to investors. It appears that investors are increasingly interested in and understand disclosure relating to intangibles. Exactly, right? Because, you know, we have seen companies with $1 trillion valuation. I think Apple company crossed $2 trillion valuation in 2020. Yes. So company with $2 trillion or $1 trillion valuation, they have a few tangible assets. So that means the major thing is intangible asset. And if you just think that current accounting standard IS 38 does not allow you to record internally generated goodwill, which is a very big asset. They don't allow. So that means whatever present in the financial statement, in the income statement, in the SOFP, in the income statement, in the SOFP, and whatever their valuation in the stock market, there is a big difference. There is a big difference, right? So definitely investors want to know. Definitely investors want to know this difference. Definitely investors want to know this difference, right? So a concern is that A concern is that due to the nature of IFRS disclosure requirements, investors may feel that the information disclosed has limited usefulness, thereby making comparison between companies difficult. Right. Listen, very easy, very easy. Just think, there is one company that grew organically, and there is one company who grew through acquisition. There is one parent company who's acquiring different subsidiaries, and there is another company who is growing organically, right? That means no takeovers. So the companies who is growing externally through takeover, definitely they will record the purchase goodwill. But the companies, they are growing internally through organic growth, no more internally generated goodwill in their books. So if you compare these two books are not comparable at all. So that's the problem for shareholders. One more thing I would like to add here, and yes, you can add these points. These are very relevant points. Listen, you know, this is IAS 38. You all know that the standards with the name of IAS, the standard with the name of IAS, the standards with the name of IAS, they came in the world before 2001. So that means IAS 38 launched in 1990s time, before 2000. Just think, when this standard was launched, there was no Amazon, there was no super hit Apple company as they are today, there was no Tesla, there was no Facebook, there was no Google, there was no super hit Microsoft like today's. So just think, when the regulators made this standard, no such things were present. No cryptocurrency was there, no Bitcoin was there. So in today's world, this standard needs to be updated. So there is a big criticism on this standard because of this issue. Just think. So there is a probability that with respect to time, they might update this standard, right? Now, many companies spend huge amount of capital on intangible investment, which is mainly developed within the company. Yes, that research and development thing. Yes, we create our own intangible assets. We do research and development, and thus may not be reported. Often, it is not obvious that intangibles can be valued or even separately identified for accounting purposes. The integrated reporting framework may be one way to solve the problem. Yes, we'll discuss this integrated reporting thing. This is a separate from IFRS, and in this area you can discuss many things which are not covered in normal IFRS income statement, SOFP, SOSHI, and all these areas, right? So now let's move to the requirement. Discuss the potential issues which investors may have. Number one, accounting for the different types of intangible asset acquired in a business combination. Business combination means takeover. Somebody is asking that will we get recording? Yes, you will get recording. Don't worry. Now concentrate, please enjoy. First of all, in the first requirement, they are asking accounting for different types of intangible asset acquired in business combination, right? Business combination means takeover. Now go slow. You know, this is P company and this is S company. There are many intangibles which are not recognized in S company's individual financial statement. There are many intangible assets which are not recognized in S company's individual financial statement. For example, internally generated brands. IAS 38 does not allow to record internally generated brands, right? Similarly, customer list, customer data, right? Because normally you can't calculate the cost of these things. Cost means original cost. You can't calculate the original cost of these things, right? So there is a possibility that there are many intangible assets which S company has, but S company has not recognized it yet because of IAS 38. But now, when parent company acquired the running business, when parent company acquired the running business of S company, that means parent company purchased it. That means parent company purchased everything of S company. So now that intangible brands, that customer list, that data is purchased asset, is purchased intangible for parent company. And yes, you can record purchase goodwill, purchase brand. So even you, whatever I'm teaching you right now, you guys did in F7 FR level. So this is the requirement of IFRS 3, that at the time of takeover, parent company calculates the fair value of different intangible asset, and they capitalize it in the consolidated books. And this transaction is treated like a fair value adjustment. Right? So again, the first issue, listen, that means if you compare these consolidated books with a normal company's books, in consolidated books, it is recognized. These types of purchase brands, customer list are recognized. But in the normal books of any company, they are not recognized. So again, the comparability issue. This is the first issue for investors. Second issue, you record when parent company acquired S company, it is the requirement of the standard to bring complete S company to fair value. When parent company acquires S company, it is the requirement of the standard to bring complete S company to fair value. So that means you will record these intangible assets at fair value as well. You have to record these intangible assets at fair value as well, right? So you record it. Now, once you record it, but for these things, they must be separable. Or they arises through legal and contractual rights. They must be separable. Separable means transferable, or they are acquired through legal or contractual rights. This is the condition. Now, once you record these intangible assets in the consolidated books, now there are two issues. If they have a finite life, you started amortization of these. Intangible assets. Now, listen the problem. This may be a current issue. Listen. But all intangible assets are not same. All intangible assets, listen to me, are not homogeneous. They are different types. Listen, for example, there is an intangible asset patent. Patent. You acquired, parent company acquired S company, and parent company recognized this patent. Now this patent has a simple 5 years life. For example, you registered it for 5 years and you are going to get the benefit for 5 years. So it's okay. Its remaining life is 5 years. So you spread the amortization over 5 years. But listen, S company has some customer data or customer list. You know, customer data and customer list is very useful. And normally in the single company's financial statement, it is not capitalized. But when parent company acquires, remember, just think about your F7 FR course. You did this transaction. In your F7 FR course, you did this transaction, customer data, customer list. When parent company acquires this company, parent company records this customer data or customer list at fair value. And then parent company calculates the possible life, and then they start amortize it. Now just think, there is a big difference between patent. There is a difference between patent and customer data. Patent is a very simple intangible asset. It will give you 5 years benefit. But customer data or customer list, look at here. Customer data, please be active. Customer data or customer list. Customer data or customer list keeps updating. Means once P company acquires S company, P company also takes this data and add more data in it. So this intangible asset should be revalued in future, but there is no such requirement, because you record intangible asset at fair value just at the date of acquisition. That's it. At the date of acquisition, no further revaluations. So there is a difference between patent and customer data. Customer data should not be divided over useful life, because this is the data which keeps updating. Even parent company adds value in it. So this is a different type of intangible asset. So Those who criticize intangible asset standard, they say there should be different treatment for this. No more separate amortization, no more simple amortization on it. Okay, so these are some issues which you must know. Okay, so let me show you. I have written some points for your, and I'll send you these points as well. Don't worry, just for your simple, just have a look. Requirement of IFRS 3 to record complete S company at fair value. Yes, we all know at the time of acquisition. So intangible assets, if separable or arises through contractual rights, must be recorded separately at their fair value. You need to recognize them. Okay, and then once you recognize, if they have a finite life, then you need to amortize. If indefinite life, then at least annual impairment testing. This is the basics of IS 38, and you guys are in revision days, please don't forget. So if indefinite life, you can't do any amortization, and but then you have to do impairment testing at least annually. Impairment testing at least annually, right? Now the issue is, this is the issue, is all intangible assets are not same. All intangible assets are not same. Example of patent, they have 5-year simple life, for example. So it's okay for amortization. But customer list or data, P company constantly update this list, add something. So simple amortization treatment does not look appropriate. But current treatment of IFRS says simple amortization. So special disclosures are needed here to explain investors the reality. Okay, so this is not relevant for users. The current treatment is no longer relevant for the users. So this is a criticism. This needs to be updated. Take your time. Just have a look, please. Have a look. Did you understand? Just give me a slight feedback on chat box. Did you understand 70%? I never force you to understand 100%. Did you understand 70% of my discussion or 60%? Okay, now I'm going to discuss the second requirement, which is the normal IS, which you attended in the class as well. Listen, the choice of accounting policy, of cost or revaluation models allowed under I for intangible assets. Now, wait. You just not only discuss the treatment of IS 38, but discuss the potential issues. See, this is the requirement. Discuss the potential issues which investors may have with the choice of accounting policy of cost or evaluation. Now, look at here. We all know that in IS 38, first of all, initial recognition. Initially, IS 38 says intangible assets are recorded. Intangible assets are recorded at cost. Okay, cost means purchase price, whatever we are paying, right? Now for further measurement, like IS 16, you have done IS 16. There are two models available, cost model and revaluation model. This is for IS 38. Two models available, cost model and revaluation model. Cost model is very famous, and to be very honest, 99 or 98% of the intangible assets in the world are recorded using cost model. In revaluation model, IS 38 has applied a very strict condition. For IS 38, if you want to use intangible asset, if you want to use revaluation model on intangible assets, if you want to use revaluation model on intangible assets, then listen to me, only allowed if active market of that intangible asset exists. If there is an active market of that intangible asset, active market means that intangible asset is being sold on a daily basis. On a daily basis, there are certain transactions. You can easily check the price. On daily basis, there are transactions of that intangible assets. Okay. So if you see the world, historically, there were very less or no intangible assets, right? But in my lectures, in my previous lecture, I gave one example of New York taxi license. New York taxi license. This example I've already given. You know, in New York, it's a big financial hub. So US government has allowed to trade the taxi license. You can trade your taxi license. And this is a very famous business there. So normally daily on daily basis, you see some transactions on this taxi license. So yes, you can apply according to some trainers. According to some trainers, they say, yes, you can apply a revaluation model on New York taxi license. The second example nowadays that's very super hit, cryptocurrency. You have, I'm sure you have studied the cryptocurrency, my class, as well as the article. In the article on accglobal.com, they have openly discussed that we apply IS 38. So when we apply IS 38, so cryptocurrencies like Bitcoin and different coins, they are actively traded. So yes, they have active market. So you can apply revaluation model. You can apply revaluation model. Now, what's the problem? One problem. Now there are two types of this problem I've already discussed you while reading the question. There are two types of entities in the market. Number one is acquired entities, and number two, organic growth. Organic growth, right? Organic growth entities. So the for acquired entities, you record almost all intangible asset, even the purchased goodwill, right? But for organic growth entities, they don't recognize many intangible assets. So in that case, this comparison is not like with like. One more issue. For example, listen, there are, this is organic, this is purchased subsidiary. Listen, these words, very important words. Let us say already there is an intangible asset which is allowed by IS 38 that you can record. For example, a normal license you can record. So in organic books, you have to apply cost model. In organic books, 99% of intangible asset, we apply cost model, right? But in the consolidated books, look at here, in the consolidated books, at the date of takeover, you need to bring everything at fair value. So intangible assets will also be at fair value. So again, there will be a comparison issue. Between these books, organic books, and these acquired books and these consolidated books, right? So this is the problem. Now, next thing is the capitalization. Keep one thing in mind. I have discussed too much because this 7 marks for all these 3 points. Listen, you have 7 marks for all these three points. So you don't have that much time to discuss. And according to the latest feedback, according to the recent feedbacks of students, many students have problem completing the paper. That's why highly recommended to solve 2-3 mocks before the exams. Okay. So you can't try, you never write the whole story. Even in the last attempt, I updated a detailed status on LinkedIn, Facebook, all my profiles on WhatsApp, everywhere, that many students are writing thesis. They are starting discussion like a thesis. No, you don't need to write thesis. To the point, you have to give answers. Now the next issue, capitalization of development expenditure. Now just discuss research and development in very short way. So you know, research cost is expense. Research is expense because this is very initial stage. Development stage, yes, you can capitalize. if you meet the pirate, PIRATE, those 6 conditions, if you meet, you can capitalize. The third issue, if we can't distinguish between research and development stage, then again expense. For example, you are in a stage where where company can't say that we are at development or research. We are in between. We are in between research and development. So to be on the safe side, the current standard says this amount you have to book in P&L. This amount you have to book in P&L. Now listen, the issue. For investors, this research and development expenditure disclosure is very important. Obviously, when I'm telling you the whole world is running after intangible assets, major, even after COVID, the industry which got the most benefit is intangible asset. All this Zoom, online teaching, online shopping, online platforms, e-commerce, everything is now intangible asset. Work from home, all these softwares, these all are intangible assets. You can understand. So after 2020, we see the boom of intangible assets. And you know, in intangible asset, it's all technology. And in technology world, research and development is very important. So if you keep doing research, you will beat your competitor and you will be on top. So this thing shareholders wants to see the research and development cost, right? Although we book research as an expense, but ultimately because of research, we get benefit. If we see practically, because of research, ultimately when we go to the development stage, we get a big benefit when we launch the product, right? So these research and development, when it is incurred, normally analyst, ANALYST, the stock market analyst, when they see that company is spending good amount on research and development, they see it as a positive thing and they incorporate this thing in the stock market share price. So the market share price goes up if company spends. You can see the latest example of Netflix. Even the Netflix share went down from $700 last 52 weeks. If I tell you the last 52 weeks story of Netflix, the highest 52 weeks high was $700 and 52 weeks low is $162. The share price of Netflix in United States from 700 to 162. But still, it's a big down. But still, the company claims that we are spending on research, we are spending on our own production. You guys know this, that Netflix makes their own seasons, own movies as well. So they spend a lot on research and development, and that's the key. That's the key for such companies. That's the key for such companies, right? Okay. So now read it. For investors, this research and development disclosure is very important. They can predict innovation capacity of companies, but currently IS 38 disclosure requirements are not extensive. For these research and development, the requirements are not up to the standards of this current time. Normally, investors incorporate this value in share price of company because stock market works according to the future of that company, right? So these points I have written for this first 7 marks requirement. First 7 marks requirement. Now, next, last requirement of this question. Discuss, please student, be active. Discuss whether the integrated reporting can enhance the current reporting requirements for intangible assets. Yes. First of all, you must understand that the number crunching financial statement, the SOCI, the SOCI, statement of changes in equity, SOFB, statement of cash flow, these all are financial world. This financial information is not enough in today's world to communicate the real picture of the company. That's why we have the integrated reporting model, management commentary thing, and a lot more. APM, additional performance measurement, So, so now we need these data, these supportive data to communicate the reality of our financial statement to shareholders, right? So let me, in this question, first of all, again, I repeat again, in this question, you don't need to discuss complete integrated report. See, it's just 4 marks. It's 4 marks. They are just saying discuss with respect to intangible asset. Discuss with respect to intangible assets. So if a student just copy paste complete all components of integrated reporting and then in the end write one line for intangible asset, that means you are going in irrelevant. They are asking X and you are writing Y. So then don't expect good marks, obviously. So during your practice, read requirement very carefully. What examiner is asking, try to read 2 or 3 times. Now, just for your easiness, I am writing the definition of integrated report. An integrated report is a synthetic document containing information about company's business activity. Just think, in the financial statement, you don't discuss business in depth. You just write the numbers. So it's better you write separate discussion of business, its ecosystem, and how value is divided between its stakeholders, customers, investors, employees, suppliers. That means how companies benefiting all these parties, how these parties are affected by the companies steps. What is the future of company? Now, let me give you some latest example of Netflix, because this is the latest issue. Netflix share price went from 700 to 162. If you see their profits, the downfall of share price is more than 70%, more than 70 to 75% down. Listen, if you see that the change in their profit, the profit is not changed by declined by 75%. No, hardly it's 10% change in profit, but see the share price went down from 75% down. Why? Because in the integrated report, company discussed these all issues, that company has 222 million subscribers worldwide. Netflix has 222 million subscribers worldwide, out of which 75 million subscribers they have in USA, Canada. And in USA, Canada, there are many people, they still use the cable TV, 80 million subscribers. So, but because of password sharing, I'm just discussing this practical issue so that you understand things practically. But because of password sharing, you know, in Netflix, if you buy the subscription, you can give password to your brother, to your friends. So with one subscription, 5 or 4 people can watch Netflix. You better know this thing. So because of this password sharing, even these cable TV guys are also watching Netflix. So there is no more opportunity for growth. And in the integrated report, the Netflix management has written this thing. They have written that now we have the problem of growth. We are not getting new subscribers because we have competition with Amazon Prime. We have competition in India with that I forgot the name. Hotstar, I think Hotstar. Yes, Disney Hotstar. So because of this competition, and the future was dark, that's why the share price went. That's why the share price went. Yes, in that integrated report, they also write that because of Ukraine-Russia war, you know this thing, Netflix is an American company. And almost all American company, they have stopped giving service to Russian people. They have stopped giving services to Russian people. So Netflix also came out. McDonald's came out. Subway came out of Russia. They all are out from Russia. So that means now Netflix is not giving services to Russia. So that means decline in subscriber. So in the integrated report, these all information are available about the business future, about the competition, about different stakeholders, about the world politics, war and all. So this gives a more realistic picture. Are you getting? But now come to our topic, that is intangible asset. Intangible asset. The biggest issue with the intangible asset is, look at here. Normally, intangible asset include internally generated goodwill, internally generated brands, yes, customer list, which are normally not recognized in the financial statement, not recognized in the financial statement of individual companies. So the equity or net assets, the carrying value of equity or the carrying value of net asset is very small amount. But if you see the market capitalization, if you see the market capitalization, stock market valuation, it's too much. So there is a big gap. There is a big gap between the net assets, which is written in the company's SOFP. Look at me. There is a big gap between the net assets reported in the SOFP and the value of equity in the stock market. There is a big gap, and this gap is mainly because of intangible assets. This gap is mainly because of the intangible asset, because we don't recognize many intangible assets. Current IAS 38 does not allow us to recognize many intangible assets. So now integrated report plays a very important role, because on this integrated report, there is no IFRS. See, on income statement, on SOFP, on SOSHI, yes, you have to apply IFRS. You are bound to apply international accounting standard. But integrated reporting, you can discuss, in theory, you can discuss all these things. You can discuss many things which are relevant for investors. So that's the benefit of integrated reporting regarding intangible assets. Now look at here. Now intangible assets play a very important role in integrated report. It helps user to understand the gap. I just told you, gap between the carrying value of net assets in SOFP and fair value of equity in the stock market. There is a big gap. Normally intangible assets are recorded at cost. At the time of takeover, only one time fair value valuation. Now just think about the issues. For normal companies, organically grown companies, intangible assets are recorded at cost, 99% at cost. Now come to the second type of companies, the acquired ones. The subsidiaries, parent and subsidiaries. Yes, when parent company acquires subsidiary company, parent company records each and everything of S company at fair value. So at the time of takeover, just one time you will bring the intangible assets at fair value. No more further revaluation, okay? No more further revaluation, just at the time of takeover. So there are two types of companies. First of all, organically grown companies, they record intangible assets at cost. Second type of companies, the acquired ones, the consolidated entities, they record intangible asset at fair value just once at the time of takeover. What about the further? What about the further measurement? What about 2 years, 3 years future forward? So now we need an integrated report for all these problems, because in future you don't record it. At fair value. So now you need integrated help of integrated report. See, that's why still problem. So integrated report covers all future aspects, things not covered in numbers. NOS means numbers, are covered by IR means, for example, growth strategies and many things. One more thing, sometimes charity or CSR, corporate social responsibility, now this is very common nowadays. Companies do CSR activities, company does charity activities on large scale, and they do market that we are doing such a big thing. For example, the best example is that guy, owner of Microsoft, Bill Gates. Bill Gates does a lot of charity, and because of this charity, he's very super hit. He gets brand recognition, right? So, but in reality, charity is expense. We don't capitalize charity as an asset. So this charity is not recorded in the financial statement as an asset in your carrying values, but in reality, because of this charity, your brand is going up. So integrated report covers these type of events, that we did this level of marketing or we did this level of charity and brand recognition. So that's why integrated report is important. I hope you got it right. But in the exam, you don't need to write in that much detail, as right now I'm doing these things for teaching purpose, because I want to put things in your mind. Did you understand this? These all? Okay, my dears, you will get the slides. Don't worry about it. Now we are moving towards the articles. Even in my last revision days, in my last attempt revision days, already in your LMS or already it's on YouTube as well, I discuss crowdfunding. But right now I want to discuss one question as well in the article. So, you know, as the startups right now in fashion all over the world, even in Pakistan, India, USA, China, startups are in fashion. So when a newly starting people, they don't have source of finance, so they generate from investors, right? They sometimes go for crowdfunding, that a common man can invest in them. So there are different types of how. Now the question is how to record that crowdfunding, because when you receive funds, you have to debit bank. I repeat, whenever you receive any funds from any person, you will debit your bank. Now the question is what you will credit. You have option to credit equity, yes. You have option to credit liability, yes. You have option to credit P&L, yes. And you can also credit deferred income. So there are many options. There are many options. This thing is clear that initially you need to debit the bank. Credit side, there are multiple possibilities. On the credit side, there are multiple possibilities. Okay. So students, look at here. These are the some basic definitions. Even in my last session revision days, I discussed this. Read it. Some are equity-based crowdfunding. The equity-based approach is targeted at investors who receive shares. Obviously, we give the residue interest in the assets to those people, right? Or we can say we gave them voting rights type thing. Now, debt-based crowdfunding. With debt-based crowdfunding, a contributor makes a loan to a business that's looking to crowdfund with the intention of subsequently being repaid with interest. Yes, if somebody is giving us money with the intention of getting fixed return, so again, this thing is it's a loan, right? Now, the third point is reward-based crowdfunding. For example, I launch a new institute and I ask for the funds, and in return I told them that I'll teach your kids or your family members or your close friends. You can send 10 students after a year. Do investment right now. Do investment in my company right now. And in next 2 years, you can send 20 students free of cost. I'll teach free of cost, right? So it's like reward based. Now, this involves promising specific rewards to contributors before the launch of a new project, product, or business. A reward-based campaign is not generally targeted at contributors who are looking to profit from their investment, but at those who want to own a new product, right? So they will be getting the product itself, right? So in these cases, we sometimes books revenue, but again, this is the issue that right now we have received the funds, but we have not provided anything to them. Right now, look at me very carefully. Right now we have received the funds, but we have not provided any goods or services, but we promised to provide goods or services in the future. We promised to provide goods or services in the future. So in that case, you book deferred income. You book deferred income, or according to the new IFRS 15, we use the word contract liability. We use the word contract liability, right? Now, donation-based crowdfunding. Contributors make donations to a project or company and may receive existing rewards. Yes, you give something your existing product. So in this case, you book revenue immediately. In this case, you don't have any obligation to transfer. We don't have any obligation to transfer anything to them in future. We don't have any obligation to transfer anything in future. So yes, it's your revenue. Some forms of donation-based crowdfunding don't involve any sort of reward, as donors wish to contribute for a particular cause. Yes, take it. So it's our benefit. It's our benefit, right? So these are the different types of crowdfunding. Right? Now, read this. This is the general paragraph. Obviously, if you are treating it as equity or loan, then you go for financial instrument. If you are treating it as equity or loan, then definitely you will go for financial instrument, because that area is covered by financial instrument. But if you are treating it as revenue, then you have to go to IFRS 15. Then you have to go for IFRS 15. Now look, now again, there is an issue with IFRS 15. There are 5 stages. Listen to me, students. There are 5 stages. Number 1, listen, look at here. 5 stages in IFRS 15. The last stage is book revenue. So there are 2 points how to book revenue. The first is point in time, and the second is over time. So you need to check which method you should use, the point in time or over time, according to the situation. Point in time and over time according to the situation. Please have a look. If the crowdfunding campaigns involve the issuing of rewards, then IFRS 15 should be used to determine when to recognize revenue. For each performance obligation, the company will need to determine whether the performance obligation is satisfied over time, that is control of the goods or services to transfer over time. If one or more of the criteria in IFRS 15 are met, then the company recognizes revenue. Yes. If none of the criteria is met, then control transfer to the customer at a point in time. Now wait. Hope you remember whenever you studied IFRS 15, in the last stage you discuss overtime and point in time. In overtime, you find 3 conditions. In overtime you find 3 conditions, and out of these 3 conditions you have to meet any one, then you can book overtime revenue. But for instance, if none of the 3 conditions is met, then you go for point in time. But for point in time, definitely the control must be transferred. The control must be transferred, right? Now, here there is a question, very interesting question, very different one. If you have already read the articles or you have solved the kit, then you can do it. Even this is linked to little bit F7 FR level. Do you know when the outcome of the contract is uncertain? Anybody knows when the outcome of the contract is uncertain, what treatment we do apply? Please write on the chat box. Please, let's communicate. Tell me, let me tell you, when the outcome of the contract is uncertain, then you can only book revenue to the extent of the cost incurred, which is recoverable. I repeat, when the it's about IFRS 15 and very famous dialogue. When the outcome of the contract is uncertain, then you can book revenue to the extent the cost you have incurred, and that cost is also recoverable. Then you can book the revenue to the extent of the cost, so automatically the profit will be zero. Just think, if you have incurred cost of 100 rupees, so you can book the revenue of 100 rupees as well. That's it. So automatically the profit will be zero. Profit will be zero, right? But in this case, you can only book this revenue if this cost is recoverable. If this cost is recoverable, right? Okay. Now, keeping this in mind, let's read this paragraph. Let's read this paragraph. Okay, be active now. On 1st September X9, Burnett Company decided to undertake a crowdfunding campaign to finance the production of a new racing bike. See, they are launching a new racing bike. This is their product. Okay. The Kraken. They made a short film with famous cyclists which set out the qualities of the Kraken bike and posted it on the Paddle Starter crowdfunding platform. Okay. This is a platform which will generate them the amount, right? So they use this platform, but this platform is not free. Now, the campaign raised $4 million. Now, that means initially they receive bank debit 4 million. They receive 4 million. Okay. On which Paddle Starter charged 7% commission. Come on, calculate. 4 million times 7% is how much? $4 million times 7% is 280,000. 4 million times 7% is 280,000, right? Okay. Now listen. 4 million times 7% is 280,000. So this is your first cost. Don't forget, commission is your first cost. Okay. Now, the contributors of the crowdfunding campaign were promised. See what we are giving in return. Were promised a reward of 1 Kraken bike for every $4,000 contributed. Now wait. We receive $4 million, and for each $4,000 we will give 1 bike, 1 Kraken bike. Tell me how many bikes we have to give. How many bikes? Come on, you guys are no more kids. Quickly tell me how many bikes we have to give. Very good. 1,000 bikes. How? We generated 4 million and divided by 4,000. 4 million divided by 4,000. This is 1,000 bikes. This is 1,000 bikes. Okay. 4 million divided by 4,000. This is 1,000 bikes, right? So we have, now that means we receive this 4 million. In return, we have to give 1,000 bikes. Now, first, easy thing. These points you can score. See, these are the easy points. Have you delivered these bikes right now? No. No. So definitely initial entry will be deferred income. Or contract liability. Initially, the transaction is a contract liability. Initially, on the day one. When you receive the funds, it's a contract liability. Okay. Now look at here. At the financial year end of 31st December X9, Burnett Company had manufactured only 50 Kraken bikes at a total cost of 240,000. But none had been delivered to contributors. Okay, no issue. There was some doubt. See, this is the real turning point. There was some doubts as to the capability of the company to develop, manufacture, and deliver the bikes promised. But see, this is the case. See, this point clearly says that the outcome of this contract is uncertain. The outcome of the contract is uncertain. So I told you these are the wordings. If you guys can go and check in your book, check in your exam kit, these lines are written. When there is uncertainty of the outcome, then you can only book. Look at me. You can only book revenue to the extent of cost incurred, provided that cost is recoverable. Okay. Now, but Burnett companies sure that the funding will cover any cost incurred. Yes, whatever cost you have incurred, you will recover it. So in this case, you can book revenue to the extent of cost incurred, Now my dear student, my dear active students, come on, quickly tell me how much cost we have already incurred. How much, which student can tell me how much cost we have already incurred? 240,000, and other one is, there is one more cost, 280, 240k and 280k, 240 and 280. Yes. So we have incurred 520k. And this cost is recoverable. So you can book revenue to the extent of 520. You can book revenue to the extent of 520k. Right? Yes. Now tell me, how much initially you received? All of you, please tell me. 4 million. 4 million you received, and out of 4 million, 520,000 will be transferred in the revenue account. Out of this 4 million, 520,000 will be transferred in the revenue account, and remaining amount is deferred income. Remaining amount is still deferred income. Is how much? 3480000. 3480000, I think. How much? Is this the right amount? 3480000 in the deferred income account. Now just giving you 1 minute to read it. 1 minute to read it, and then I'll show you the examiner comments on it. Okay, read it, please. Check it, please. Check it. Take your time. Just quick walk through it. Take your time. Okay, you can see this. Now, in the same article, if you read the same article, you will find some sort of revision of impairment of financial instrument. When you guys were doing IS 36, your teacher taught you that there are certain areas on which you can't apply IS 36. There are certain areas on which you can't apply IAS 36, IAS 36, right? And one area is financial instrument. On financial instrument, there are separate rules. On financial instrument, on financial assets, there are separate rules. Okay, right? And one thing in financial assets, sorry, for financial assets, hope you remember there is one is debt market, one is equity market. When you talk about financial asset, yes, you can invest in equity market and you can invest in debt market. In equity market, there are two categories: fair value through P&L and fair value through OCI. There are no impairment rules for equity market. There are no impairment rules for equity market straight away. But yes, in debt market, if you invested in a debt instrument, that means if you have given loan to somebody, in that case, there are total three categories. One is amortized cost, one is fair value through OCI, and one category is fair value through P&L. Okay, in debt market there are three categories. Now the question is this impairment accounting, where we are going to apply this impairment accounting. We can apply impairment accounting for amortized cost. Look at here, for amortized cost investments and fair value through OCI investments. Okay, don't forget this. We can apply this impairment accounting on amortized cost investment and fair value through OCI investment. I'm sure you all must know these things. Now, and you all better know this, previously when IAS 39 was there, there was one model, incurred loss model. And now the latest model is expected loss model. Previously in this world there was incurred loss model. Now in this current world we have expected loss model. Incurred loss model is like bad debts written off. In incurred loss model, they normally wait for objective evidence. But in expected loss model, you don't wait for objective evidence. Or in very simple words, whenever I teach this topic, I teach with comparison of your basic accounting. When you guys were doing high school, when you guys were doing O levels, A levels, when you guys were doing F3, FA level exams, remember you used to do a bad debts chapter. The practical accounting of this topic is almost like bad debts chapter. So previously incurred loss model was like bad debts written off. And now this expected loss model is like allowance for doubtful debts, provision for doubtful debts, or allowance for doubtful debts, right? Okay, so in incurred loss model, the entry should be bad debt debit, and you simply credit the receivable. Right? But in expected loss model nowadays, you make the entry expense debit and allowance, for receivable, credit according to the stages. You do this. Okay, so now just the impairment model of IFRS 9 introduces three stages. These are the three stages. Let me summarize you. Stage one. Normally we are at stage one when there is a very low risk, when there is a low credit risk, right? So in that case, you just see this word, you just book 12 months ECL, expected credit loss, are recognized, which means that entity has to calculate the expected losses in the next 12 months, taking into account the risk of default. Now, what does it mean? Listen, we use the word for stage one. Look at here. We book only next 12 months expected credit loss. What does it mean? It means If, it means if default occurs in next 12 months. If default occurs in next 12 months, so whatever loss we will face for the whole life, we have to book. For example, if in the next 12 months, our debtor goes bankrupt, if in the next 12 months, our debtor goes bankrupt, so because of that bankruptcy or because of that problem, whatever loss he will give us, we have to book it, multiply by the probability of default, PD, multiply by the probability of default. Okay. So this next 12 months does not mean that whatever funds he will not give in next 12 months. No, 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 no. This is not the meaning of next 12 months. Next 12 months means if, listen it again. If that party, the other party defaults in next 12 months, so whatever loss he gives us because of that default throughout, we'll calculate the present value, we'll calculate the present value of that default, and we'll multiply that present value with the probability of default, PD. This is the meaning of next 12 months. Okay. Now stage 2. Stage 2 deals with the financial instrument that have a high increase in credit risk, but again, listen, there is no objective evidence. You know what do you mean by objective evidence? Objective evidence means my debtor called me and he said, no, sir, I can't pay you now. This is the objective evidence. My debtor called me and he says, please give me some concession. Please, I can't, I'm getting bankrupt. Or his lawyer called me. So these are objective evidences. So in stage 2, again, you don't have, objective evidence. Although that party risk is very high, the credit risk is high, but again, you don't have objective evidence. So again, this time you'll make the entry of allowance. So in the stage 1, the entry, the entry is P&L debit, allowance for receivable credit. Same entry here. Same entry, you'll multiply P&L debit and allowance for receivable credit. Okay. But yes, the expected losses over the life. Now you are not going to book next 12 months, only next 12 months. Now you are not going to book only next 12 months, but for the whole life. Now you are going to see the picture of O for the whole life, right? Stage 3. This stage 3 is the old model. This stage 3 is the incurred loss model. This is basically incurred loss model. Now you have objective evidence. Always listen this. Even if you read your study text, even if you solve, test your there are some test your understanding in the study text. If you see of financial instrument, you will find this thing, and the identification of stage 3 is objective evidence. Now the lawyer called you, the opposite guy called you that I can't pay, or that's the issue. So there is objective evidence. So now you have to make the entry bad debt debit, C, expense debit, and you will simply credit the receivable. So now the carrying value of receivable will change. In the first 2 stages, the carrying value of receivable won't change, but in the stage 3, you will simply change the carrying value of receivable. Okay. And once you change the carrying value of receivable, so your future revenues, your future interest income will be calculated on the revised. Your future interest income will be based on revised carrying value of your receivable. But in the first 2 cases, you will still be booking. In the first 2 cases, you will be still be booking interest income on the basis of gross amount, on the basis of gross receivable, on the basis of gross financial asset. That's the difference. See this. Interest revenue is calculated the carrying amount less the ECL allowance. Now let's do this thing. With numbers. This question is given in the article by examiner. Okay. So please be active and you will understand. If you know a little bit about this, on 1st January X6. See, this is the beginning date. This is the beginning date of this story. This is the beginning date of this story. Lunar Company granted Skyzer Company a $5 million secured loan repayable on 31st December X9. Okay, so X6, 7, 8, and 9, 4 years loan, 4 years loan with an interest rate of at the reporting date. Okay, 3% payable annually at the reporting date. Now they have covered 3 years. Listen, you go with first column, then second column, and then third column. And in the first year they discuss stage 1. The first year is 2006. Just think about it. 1st January X6 to December X6. This is your 2006. In 2006, your examiner discussed the stage 1. In 2007, they discussed stage 2. And in 2008, they discuss stage 3. Okay, they will communicate pure, right? Now, first of all, this is the stage 1, the first year. Just read this column. My dear student, just look at here. This column is right now relevant. On 31st December X6, there has been an increase. There has been no increase. See, no increase. That means low credit risk. There has been no increase in credit risk. And the probability of default in the next 12 months is 5%. See, I told you, in the stage 1, they will always give you, in the stage 1 accounting, they will always give you probability of default. Now, the present value of the cash shortfalls expected over the life of the instrument, if the default occurs in the next 12 months, is 200,000. Exactly the same wording they are using, which I told you. You are not getting. Stage 1 means, listen, in stage 1, when we use the word next 12 months, it means if that guy defaults in next 12 months, if that receivable defaults in next 12 months, so whatever amount he won't pay us throughout the whole life, we have to consider the present value of that amount. Okay, see this, see the words. The present value of the cash shortfalls expected over life of the instrument if the default occurs in next 12 months is 200,000. So now, how to calculate the allowance? I told you, the present value of these losses multiplied by the probability of default. Simple method. Present value of these losses multiplied by the probability of default. So here you go. 200,000 times the 5%. How much is this? 200,000 times the 5%. How much? Please tell me. It's 10,000. 200,000 times 5% is 10,000. 200,000 times 5% is how much? 10,000. So now this is stage 1. Can anybody tell me what is the double entry for stage 1? Stage 1 is pure allowance. Stage 1 is not written off. It's pure allowance. What is the double entry? Tell me, please. Write on the chat box. P&L debit and allowance for receivable credit. Allowance credit. This will be the entry. Entry will be, let me write here on the top. So this is the entry. This is the entry for first year. And now just think, December X6 is gone. Just one more question from you. How much interest income we'll book? We'll simply book 3% of 5 lakh. We will be simply booking 3% of 5 million. 3% of 5 million will go in the P&L, because allowance accounting is a separate accounting. Your gross receivable will remain same. Your gross receivable will remain same, and your interest income, your interest revenue will be calculated on gross receivable. Okay, this is for stage 1 and stage 2 as well. Now, one more thing. If you guys have done basic accounting in your life, if you have done the basic accounting, you remember the allowance accounting when you were kids, that in future periods, you just have to put increase or decrease in allowance in the P&L. Remember this thing when you were kids in your high school, O levels, A levels. Increase in allowance is treated as an expense. and decrease in allowance is treated as an income. Increase in allowance is treated as an expense and decrease in allowance as an income. So for future periods, keep this thing in mind. For future period, keep this thing in your mind, increase or decrease in allowance. Okay. So now with this thing, read the second year. But yes, at the end of the first year, how much is your allowance? All of you, please tell me. At the end of the first year, how much is your total allowance? 10,000. At the end of year one, how much is your total allowance? It's 10,000. So that means at the beginning of year two, the opening balance of allowance is already 10,000. Okay. At the beginning of year two, the total balance of allowance is 10,000. Don't forget this. Okay. So because now you have to do the increase or decrease game. Now, my respected students, watch stage second column. Now stage two. On 31st December X7, the credit risk of the loan increased significantly. Yes, increased significantly, but nothing is written. Nothing is written that we have objective evidence. We have objective evidence, and there is one more word they use, credit impaired. They use the word credit impaired. If they use the word credit impaired, that also means objective evidence. So this is a stage two. Yes, we have high risk. We have high risk, but no more objective evidence. So still we are on stage two. Now read. The probability of default occurring over the remaining life of the loan is 45%. Now PD is 45%. The present value of ECL from default events over the life of the loan are expected to be 400,000. So now, first of all, calculate your allowance. Calculate your closing allowance. 400,000 is the present value of losses. Multiply by the probability of default is 45%. Can anybody multiply? Yes, multiply 45%. This will give you 180K. This will give you 180K. Okay. Slow. Now you tell me, wait, student, your year-end allowance is 180K. Your year-end allowance is 180K. And what is the opening allowance? What is the opening allowance? Opening allowance was 10K. Opening allowance was 10K and closing allowance is 180K. So how much is the increase? How much is the increase for the year increase? Can anybody tell me for the year? 170K. Excellent. 170K is the for the year increase. 170K is the for the year increase, and this for the year increase will go in the P&L. This for the year increase will go in the P&L. This for the year increase will go in the P&L. This for the year increase will go in the P&L, right? For the second year. And again, what is the double entry? Wait. Let me make the entry. P&L debit 170,000. Allowance credit how much? 170,000. P&L debit 170,000. Allowance credit 170,000. Again, my dear students, second year. In the second year, we are again doing the accounting of allowance. So still your gross receivable will remain same, that 5 million. So still you will be calculating interest income by multiplying 5 million times 3%. 5 million times 3%, same 150,000. Okay. 5 million times 3% is 150K. Okay. Listen, somebody is asking, we are doing as at accounting. So at the end of year two, the total allowance which we needed is 180. At the end of, listen, at the end of year two, the total allowance we need is 180. But we have already created 10. We have already created and booked. 10K. So now from 10K to 180, how much extra allowance we need? How much extra allowance we need? We need only 170K now. Now listen. 2007 also gone. 2006 done. 2007 done. Now in 2008 they are discussing stage 3. First of all, at the beginning of 2008, all of you in one voice, at the beginning, yes, Yes, the question you are just asking, the answer is yes. And this is what you used to do in your basic studies. This is what you used to do in your basic studies. Now, my dear students, stage 3, 2 years gone. And at the end of 2 years, or what we can say at the beginning of year 3, you have opening allowance of 180K. You have opening allowance of 180K, right? Now, on 31st December X8, the loan is credit impaired. The estimated present credit impaired, what does it mean? This line credit impaired means, stage 3. This means we have now objective evidence. We have now objective evidence. The estimated present value is expected to be recovered is 4 million. This is what we call recoverable amount. Remember, in my classes, you can, those who are my registered students, they can go and check. They can go and check. In the stage 3, we simply calculate the recoverable amount. And recoverable amount is present value of future cash flows discounted using original effective interest rate. So this is your recoverable amount. This is your recoverable amount, which is 4 million. Okay, this is your recovery. Now there is no need to multiply with it with probability of default. In stage 3, you don't need to multiply with probability of default because things are certain now. Things are certain. You can see it. Objective evidence. Now, tell me, the gross carrying amount of the loan is 5150, which is the loan plus unpaid interest for the year. Listen, your carrying amount is 5150 and the recoverable amount is 4000. Very simple. Just apply the basics of IS 36. Just apply the basics of IS 36, my dear student. So 5150 minus 4000 will give you how much? 1150. 1150 is the total impairment. Now, very interesting point. You know, this is the point why, wait, listen my words. This is the accounting now I'm telling you. That's why IFRS 9 was launched. Because in 2008, if you guys know the history, in 2008, there was a big recession in US. In 2008, there was a big market crash. Lehman Brothers got collapsed in 2008. So at that time, there was incurred loss model. So in 1 year, companies booked billions of dollars of impairment. And at that time, the accounting standard used to say that wait for the iceberg crash, wait for the ship to hit the iceberg and then record. So that was the criticism, that to book everything in 1 year. But now this is not the case. Listen, out of this 1150, this is the total lifetime expense you need to book. You have already created some allowance. My dear respected students. How much? 180K. 180K you have already transferred in previous years. You have some storage tank with you. You have some storage safety with you, 180K. So now what entry you will make? Listen, you will make this entry. Wait, let me make here. You will first clean that allowance. Debit 180K. You will credit your receivable. You will reduce your receivable by 1150K. You will reduce your receipt. Yes, very good. One student made this entry. And you will debit the remaining amount in P&L. How much is the remaining amount? How much is it's 970, I think. This is the entry for third year. And this is the blessing of this new standard. That no need to book complete amount in one go. No need to book complete expense in one go. You already have some allowance with you. That means you booked something in past as well, so that your burden is spread. You spreaded your burden over the life. This was the objective of IFRS 9. When they launched IFRS 9 in many years back, we used to read these articles. We used to read this article that why IFRS 9 was launched. This was one of the reason. This was one of the reason. Now you tell me, from 5150, we reduce the asset by 1150. So what is the new value? What is the new value of your asset? It's 4,000. What is the new value of your asset is 4,000. So from now onwards, that means the last year. See, there were 4 years. In this question, there were 4 years, 2006, 7, 8, 9. So in the year 4, you will be book revenue now on the basis of 4,000. You will book revenue on the basis of 4,000, not 5,000. Okay, because once you apply stage 3, the value of your asset change. The value of your asset changes. Now, just for your easiness, I want to show you the examiner working, because this is the part of article. The things which I just shared with you, it's part of article. Okay, I'm moving the screen. Read it. Please read it. Read this thing. First column, second column, and third column. Please read it. I will share one article with you, very excellent article for this, and you will find some good things regarding ECL. After the class, remind me, I'll send you one article. All of you, it's a 10 to 15 minutes article. One guy is asking a question. In that article, the answer of that question is given. Okay, I'll share that article. That's very good for you guys. Okay, did you read it? All of you, did you read it? Please reply. One more thing which I've taken from the article. Normally you have seen, and you all know this, even in the last attempt past paper, if you see, IFRS 10 is very important. IFRS 10 may come in the exam, and the issue is whether you have control or not. And they normally mix it up with IFRS 11, the joint arrangement. Sometimes they check they ask you whether you have control. Sometimes you concluded that you have joint control, right? Or sometimes you say that there is just significant influence. So this is a very key area and very famous area. Examiner wants you to be prepared for it. Examiner wants you to be prepared for it. And I have recorded many sessions for this. But right now I want, this is the article by examiner. So I want to share something, because articles are always relevant for you guys, right? Okay. So now the first thing is, when you guys were kids in your F3 level, in your FR level, normally whenever a teacher starts teaching consolidation, teacher write like this, that you have P company, S company, and 50% plus shares. Normally students are taught in this way. This is the routine, that control comes with 50% plus ownership. Okay, but in SBR level, now you have seen that very less practical content you have. Even you are not asked to make the complete statements. No more SOCI, SOCI, no more complete consolidated cash flow. You have seen in your last 4 years exams. You need to discuss his theoretical aspect. So now just writing this 50% thing for control is not enough, because there are many cases in which you have less than 50% shares, but still you get the control. Still you have less than 50% shares and you get the control. Okay, so you need to apply your judgment as well. You need to apply your judgment as well. In my past classes, I have used this word that in SBR course, in SBR exam, if you are right, you'll get the marks. And if you are wrong, still you may get the marks if your answers are with arguments, with logics. If you are writing the logic of your argument, that according to me, this is the issue, and why I'm saying this, because of this, you will get the marks. You will get some marks. Obviously, the right thing is right, but so this is the benefit of SBR course, that is a practical course. So if you are wrong, but you have presented things properly and you have given logics of things, you can get the marks. Okay, and these dialogues best fits for this topic. Very, very judgmental topic. Very, very judgmental topic, right? Now, first of all, I have a question. What is the difference between IFRS 10 and IFRS 3? Please tell me on the chat box. What is the difference between IFRS 10 and IFRS 3? Can anybody? Very good. IFRS 10 tells you that whether you have control or not, whether you have control in this company or not. And once IFRS 10 gives you green signal, once IFRS 10 gives you green signal, yes, you have control. Once IFRS 10 gives you green signal that you have control, so for all complete detailed practical consolidation, takeover accounting, fair value adjustment, P2S sale, S2P sale, contingent liability issue, this issue, that issue, all these issues are covered by IFRS 3. That means the whole total consolidation which you have studied practically, all is under the head of IFRS 3, right? Okay, business combination. Now, for control, you know, this is the very famous definition of control. These 3 points normally, if you have ever read the exam kit, study text, any article or my lecture, you have seen this. Power over the, this is the definition of control. You have to meet all these conditions. Power over investee, power over investee. That means whatever investor is saying, investee has to accept, right? Exposure or rights to variable returns. Variable returns, that means if you have invested in loan notes, if you have invested in loan notes and you are getting fixed 10% return, then that's not takeover. And you better know this. Whenever in my earlier studies and in normally teachers, trainers say this, whenever parent company acquires S company, whenever parent company acquires S company, it acquires the running business. It acquires the running business of S company. It acquires the running business of S company. Okay. So whenever you acquire the running business, obviously you get the variable return. It's not fixed return. And the third thing is the ability to use its power. Current ability means current ability. Current, the day you are saying that you have control, you have the ability to change things. You have the ability to change things, right? So now examiner has written some, has given you some description. See, for power of investee, they have given you this paragraph. For exposure to variable returns, they have discussed this. For the third point, they have discussed this. This is present on your website. I repeatedly say, you guys don't do proper reading. Don't do proper, otherwise you could score even more. Although you guys score good with the lectures, but if you do proper reading, you can get distinction. See, owning majority owning majority voting right is not always necessary to have control, especially at this level. Then they don't ask straightforward questions. Instead, control requires the investor's power rights are sufficient for its unilateral direct the relevant activities. See this word, relevant activities. Relevant activities. You call it the heart of any business. Relevant activities means you call it the heart of any business. Even if you read the main IFRS book or you read your study text, they have given very good cases for relevant activities. Sometime it happens. There is a company who deals in innovative products. They launch innovative things. So there is one sales department and one research and development department. There is one sales department and one research and development department. If research and development department develops new technology, new products, innovative thing, then the sales department will be able to sell it. So that means the heart of this company is research and development. The heart of this company is research and development department, and whoever has the control over research and development department, that party has the real power. You are not getting. For example, there are two different companies. One company has rights over selling department. The other company has right over the other company has right over the other company has right over that department, research and development department. Research and development department, research and development department. And for this business, the heart of earning is research and development. The whole company is dependent on research and development. So the company who has control over research and development department has control over relevant activities. This is just an example. One more question is coming soon in the next slide. Now, for example, SBR candidate should consider who makes the operating, financing and capital decisions and who appoints the key management personnel. Yes, this is the normal point. I already told you more analysis and judgment is required to determine whether an investor with a significant minority of voting or other rights has control. Yes, sometimes we have very less shares, but through agreement we get the control. Through agreement we get the control, right? Sometimes. For example, power over investee can still exist even when another entity has significant influence. Now wait, listen. This is P company. P company has 60% shares of S company. And there is one company, Y company has 30%. Now, this is possible. Look at me. This is possible at one time right now. This Y company has significant influence of this company and P company has control. Yes, this is possible. In IFRS 10, this is clearly written. At one time, one entity has significant influence and other entity has control. This is possible. You can write in your comments. This is possible. So the significant influence by other company does not stop you. The significant influence of other entity does not stop you from exercising control. This is possible. Okay. Now, the second thing is exposure or rights of variable returns. I just told you, return should be interpreted broadly. For example, include synergy. Yes, normally when parent and subsidiary join hands, lot of synergies. You know that now you are no more kids. Returns can be negative or positive. Yes, sometimes there are negative synergies as well. A right to return that is fixed is not normally consistent with control. Example, loan notes. Okay. The ability to use its power to current ability. In more complex control assessment, IFRS 10 requires identification of the activities that most affect the investee's return and how they are directed, right? See the relevant activities. Who controls the relevant activities? Now giving you one question. See, this is the question. Not giving you the answer right now. Giving you 3 minutes. Read it and guide me. Read it and guide me the judgmental thing. J and C company holds 40% each of the voting rights of Door company. The remaining 20% are held by Hack company. Okay, so there are three major owners. A shareholder agreement state that the purpose, very good. One student gave the right answer. The purpose of Door company is to generate capital gains. This is the main activity, capital gains, buying and selling property, buying and selling properties, right? From buying and selling properties. This is the major earning thing. All decisions concerning buying and selling properties and their financing, buying and selling, require unanimous agreement of both Joe and Cat. See, unanimous agreement means joint control. So the heart of this business is capital gain, earning from capital gains. And how we earn capital gains? By buying right thing and selling at right time and using the correct source of finance. So this is the major thing, and this major thing is owned by these two. You need unanimous consent, right? So looks like apparently from this first paragraph we can see joint control, IFRS 11. Okay, now Joe company is responsible for all management activities for which it receives a payment, and additionally has the final decision on appointment to the board of directors, right? So they can appoint the board of directors as well as the other management activities they also do. Now, tell me, what are the relevant activities of this company? Relevant activities is earning capital gain. Relevant activities is earning capital gain. Other management things are not relevant activities. And relevant activities we have seen are jointly controlled because unanimous consent is needed. Unanimous consent is needed. So our answer is more to, we should comment more towards IFRS 11, right? Okay. Please check it out. The major, see, even the examiner using the word, the examiner is using the word suggested answer. See, even they are using the word suggested answer. Okay. The major finance and management activities will both affect Door company's return. Therefore, Jew company and Cat company should evaluate which set of activities are the greatest effect on returns. Okay. Given the purpose of the Door company is achieve capital gains, see, it's capital gains. This may indicate capital investment activities have the most significant impact. If so, the conclusion would be Joe company and Cat company have joint control. Right now, in the end, see, they are also discussing the multiple solution. This is what the specialty, the beauty of SBR. This is the beauty of SBR. See the last, read the last paragraph. If, however, management activities and key management personnel appointments are considered more significant, the conclusion would be that then in that case, Joe company has control of Door company because it solely directs these relevant activities. But again, the correct answer is the first paragraph, right? And listen, by reading these type of articles, see, you are learning how to answer. You are learning how to use the professional language. See the way this guy is writing, if, however. In this way, you can give the second idea as well. Because listen, right now you are with teacher. You are in the classroom environment, and the exam environment is different. In exam environment, what can I say? Things looks very difficult, tension, time pressure. Even, there is one more problem students report me in last 5 to 6 years. You guys practice, and definitely you have to practice on keyboard. Please solve questions. That's why I'm asking you to solve mock. If you are using paper and pen all the time, you will have problems. You are professional students. Please try to understand. You have to practice on your exam software. But 99% of these students do practice on laptop, and laptop keyboard is very, very delicate. It's very enjoyable. But you know, in many CB centers, they give you the old big keyboard with CPU. And when you type on that keyboard, you feel noise, tuck, 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 like this. Even this gives you a psychological pressure. That's why I have instructed many such students, those who complain this. I often say them that buy that separate keyboard and do it at home. Are you getting my point? Did you understand this question? Let's take a 6 to 7 minutes break, and then we'll continue the remaining part. Okay. Okay, students. Now, need to discuss something which is unusual. I have read it in one article. There is a question: how important is consolidated cash flow statement? Yes, you must know the basics of cash flow as well, because if it comes, normally 25 marks is not expected. Even in the question number 1, consolidation comes of 16 to 15 marks, right? But still, if you plan to leave something, it's better at least overview it to reduce the risk, right? I know for students, cash flow is a bit technical. Cash flow is a bit technical area, but nowadays they don't ask full statement. If you see last 4 years, SBR past paper, see the previous past papers were P2 past papers. The latest are SBR past papers. So if you see the latest SBR level past papers, they normally ask you to discuss the statement, the logics of statement of cash flows. Why is like this. Okay. Now the topic is, this is a unusual topic of IFRS 16. I was reading an article, and I even made a short video. On this topic, variable lease payment, but that's it. That video is in Urdu Hindi language. It's on my YouTube channel. I made a 5-minute or 6-minute video for this, right? But as this is a relevant topic for you, so let's discuss this, a very short issue. Treatment of variable lease payments. Listen, first of all, in lessee books now, after the introduction of IFRS 16, major leases are finance lease. Operating leases are almost sidelined, right? Only there are 2 cases in which you can do operating lease accounting. One is for the lease with lease term less than 12 months, and second is for low value asset. And in low value asset, still you have option. You have to do election. And you have to inform auditor that you want to apply low value asset exemption of operating lease. Otherwise, all leases are in lessee books, all leases are finance lease. In finance lease, even the property leases, even historically, when you used to take properties on rent for 3 to 4 years, it was all operating lease. But now such property leases are that historic rental leases are now finance lease as well. Okay, so now in finance lease, on day 1, you make the entry ROU debit and lease obligation credit. ROU debit and lease obligation credit, and you calculate the you do it using present value of unpaid lease rentals or present value of minimum lease payments, which includes rentals, guaranteed residual value, sometime termination clause. If it is probable, termination clause penalties you sometime include, right? Sometime there is some bargain purchase option for which you have to make payment in the end. So you include all these payments in the calculation of initial recognition, present value of lease payments, right? Now, but these payments normally, which I have discussed, they are all fixed payments. Sometimes nowadays in the agreement of lease, there are some variable payments. For example, I am giving my shop on rent to somebody, and I'm asking some fixed rent. As a landlord, I'm asking some fixed rent, and some rent I'm asking that give me 2% of your sales, 5% of your sales revenue. I'm asking the tenant that give me some fixed rental as well as give me some 2% or 5% of your sales. Now this 2% or 5% of sales is totally a variable payment. It's totally a variable payment. Okay, right? So if there are some such variable payments, what is the treatment according to IFRS 16? What is the treatment according to IFRS 16? Okay, so now look at here. Now how to account for variable lease payment according to IFRS 16? IFRS 16 has divided this topic in two heads. IFRS 16 has divided this topic in two heads. This is the first head and this is the second head. Now listen very carefully. First of all, we need to ask a question. Do these variable lease payments follow any index? Do these variable lease payments follow any index? Like, for example, they are linked with inflation. Inflation is index based. They are linked with CPI, consumer price index, or your payment will be increased with interest rate. For example, your landlord has told you that we'll increase your rent after 2 years according to that inflation, or according to that future inflation rate. After 2 years, whatever will be the inflation rate, we'll increase it accordingly, right? Or they have said we will increase according to the market interest rate, according to the market interest rates. Okay, so these things follow certain index. Okay, this is the first area. And there are some agreement with they don't follow any index. For example, percentage of sales. Landlord is saying to tenant that I will take fixed rent as well as 3% of your sales. Or one more example. Or according to the usage, example of photocopying machine. For example, I have taken a photocopying machine on rent, and the lessor is asking a fixed rent, as well as lessor is saying that according to number of copies done by you, you have to pay per copy payment. So again, now nobody knows how many copies will I do, how many printouts, how many copies will I do. So these two are percentage on sales and according to usage of photocopying machines. These two are the example which don't follow any index. They don't follow any inflation index or CPI index or interest rate index. Now, first I'm explaining you this area. See this area. These types of variable lease payments are not part of lease payment. These types of variable lease payment are not part of lease payments at all. So they will never ever be part of any ROU or lease obligation. For these things, standard has simply told you that whenever in future you will pay this, you just have to book in P&L immediate expense. Just book in P&L in the period it is incurred. That's it. Just book in the P&L it is incurred. Simple. I repeat, if your variable lease payment does not follow any index, if your variable lease payments does not follow any index, for example, percentage of sales, or for example, usage of machine, in that case, these variable lease payments are never part of the lease payments and never will be part of ROU and lease obligation. Simple treatment is in the future period, whenever you will incur these lease payments, you just have to book in P&L as it is. And one more thing, why standard has made this treatment? Because the future sales, the future photocopying use is highly uncertain. So if we start accounting for in the present value right from the day one, this thing will reduces the reliability of the books. This thing will reduces the reliability of the books. Okay, so this is very simple treatment. Now come to this side. If your variable lease payment follow a certain index, if your variable lease payments follow a certain index, in that case, these payments are part of lease, and they will also become part of ROU and lease obligation. Now the next question is, but how? But how? Wait. Are you thinking that right from the day one we will calculate the future 2 years after inflation rate? Look at here. Are you guys thinking that right from the day one we will calculate inflation rate of year 5 or year 4? No. This is also very difficult because inflation rate is also uncertain. And the best example is current year. Nowadays, you can see in United States, UK, Canada, India, everywhere, record high inflation. 40 years record, they record high inflations are there. Record high inflations are there. Are you getting? Record high inflations are there. Listen, the one guy is asking a question. I'll answer soon. Please let me complete this. I'll answer. Don't worry. Record high inflation are there. So that means you can't also predict the inflation as well. So how we will include this in ROU and lease obligation? Now listen the treatment. Listen. First of all, on the day 0, you will just use the future cash flows, unadjusted cash flows. For example, your landlord has told you that I will increase your rent according to the future inflation rate. That means inflation rate at the end of year 2. I'll increase rent after 2 years according to the future inflation rate. But nobody knows the future inflation rate. So on the day 0, on the year 0, you just have to use unadjusted future cash flows. You simply use unadjusted future cash flows and you will calculate the present value and you will make the entry ROU debit and lease obligation credit. ROU debit and lease obligation credit. Okay. Now, when you will go to the year 2, when the year 2 will come, now you will come to know the real inflation rate. Now, at the end of year 2, you will come to know the real inflation rate. So now you have to listen. At the end of year 2, you have to do reassessment. You have to calculate revised future cash flows. You have to calculate revised future cash flows, and now you have to calculate the present value. And now at the end of year 2, you will readjust your ROU and lease obligation accordingly at that time. Listen, example, landlord asked me that we will apply increment according to inflation rate after 2 years. Now, no need to predict future inflation rates. Just at initial recognition, read the lines, please. Just at initial recognition, use unadjusted numbers. NOS means numbers. But just the end of year 2, at the end of year 2, you need to remeasure your lease liability and ROU using the revised variable cash flows. Okay. So in this case as well, right from the day one, you can't, or you are not allowed to incorporate the future lease payments depending on the inflation rates or index rates. Okay. You have to wait for that event. And when that event will come, then you will remeasure your lease liability and ROU. You will remeasure your lease liability and ROU. Now, let me give you one answer. One guy is asking a question and his question is valid because I know he's a professional. He's doing job, and obviously you all have to do smart studies. Many times I've forced students, I guide students to read articles, but yes, he's saying there are 150 pages. Maybe this is the approximation. 150 pages of article on accaglobal.com. So sir, do we have to read all the articles? If you are a full-time student, yes, you can read, try to read, or do read important articles only. Now, there are some articles which are related to accounting standards. Very simple. There are some articles in which only it's about copy paste of accounting standard. Listen to me. So if it is about copy paste of accounting standard and you have taken good classes of accounting standard and you have good grip, you have done the kit, so leave it. But there are some issues, some topics which are general topics, general discussion topic, like crowdfunding. This is the new thing. This is the new thing in the world. This is the new thing in the world. It's the fashion of like 2020, 21, 22, like this time. Like ICO, initial coin offering, like sustainability reports, like something related to COVID, like something related to Ukraine war, just as, are you getting? So for those students, these topics, they must cover these topics at any cost. Like, yes, like disclosures, bin the clutter and these type disclosures. So do cover these topics thoroughly. And for other topics, you just can do scan, or you can even leave it, right? I hope you got my point. At least do these new things which are not commonly used in your course. These areas are very important for you. Did you get the answer? Okay. So don't forget about the variable lease payment accounting. Variable lease payments, I gave you the examples. If they are not linked, to any index, simply no need to include it in the part of lease payments, like percentage of sales or percentage of usage of machines. Book such payments in P&L in the period it is incurred. But if they are linked to any index, then they are part of lease payments. But for that also, you don't need to incorporate those variable lease payments from day one. Wait for the time when it is actually happened, and then you need to remeasure your lease liability. NROU. Now, very interesting topic. This, I'll give you one practical example, real life example in that. And I'm not sure you guys have done this in your normal course or not, but here you will learn something from it. Now look at here. You know, we only book deferred tax if there is a temporary difference. We only book deferred tax if there is a temporary difference, or we call it timing difference. Like, for example, very basic example, dividend income. You know, sometimes we book dividend income in our accounting books on the basis of right to receive. Yes, we have already created a WhatsApp group, Mr. We have already created a WhatsApp group. So whoever is asking, please take the link. Thank you. I repeat. We only book deferred tax for temporary difference, right? Timing difference. For example, dividend. Sometimes we book dividend income on the basis of right to receive. So we, in accounting books, we book dividend income on the basis of right to receive. But when we go to tax department, they say, no, we don't want tax right now. We'll charge tax in future. When you will actually receive those dividends. So now, my dear student, there is a timing difference. Like you are receiving, like you booked income today, but tax department will charge tax in future. So there is a timing difference, right? Okay. And this timing difference is temporary difference. And I'm sure you know the two types of temporary difference: taxable temporary difference and deductible temporary difference. For taxable temporary difference, you need to book deferred tax liability. For deductible temporary difference, you need to book deferred tax asset. For deductible temporary difference, you need to book deferred tax asset. For deductible temporary difference, you need to book deferred tax asset. Okay. Now, these are certain exceptions of deferred tax. Means in these case, you are not allowed. We are not allowed to book deferred tax. We are not allowed to book deferred tax. The first example is goodwill. The first example is goodwill. Now listen. Wait. This is P company. This is S company. Okay. P company. Look at here. P company bought 80% or let us say 100% shares of S company, ordinary shares of S company, and got the control. Now, in accounting books, please look at me very carefully now. In accounting books, we will do proper consolidation. We'll do proper consolidation. We'll compute goodwill. Yes, at the date of acquisition, we'll compute goodwill. We will do proper consolidation, adding together everything, right? That means for accounting books, purchase goodwill is a proper asset. And in accounting books, not only we record goodwill, in accounting books, not only we record purchase goodwill, but in future we book the impairment. In future, we book the impairment expense of that purchase goodwill. You guys better know these things. These are not new for you. But student, what happens when we go to the tax department? In the eyes of major tax departments, in the eyes of major tax department of the world, they treat that parent company as just bought shares. They don't treat this transaction as buying of a running business. They treat that they just bought shares. That's it. For in the eyes of tax department, this is just investment in shares. In the eyes of tax department, this thing is just investment in shares. So they don't accept any consolidation or any goodwill or something, such thing. So now listen, but in the accounting books, not only we record the goodwill, but we'll also book the impairment expense of goodwill. Now, so now just think over it. Look at me. In future, when we take this impairment expense, of goodwill to tax department, and we'll say, please allow this expense. Please allow this expense. So they will say, no. We don't allow this expense now and never. We will never allow it. Now, not even in future. So this is not a temporary difference. This is not a temporary difference. This is a non-temporary difference, like a permanent difference. So no more deferred tax on it. So no more deferred tax on this. No more deferred tax on it. This, please read it very slowly. These 4 lines. Now next, more interesting topic, very, very interesting topic. Undistributed profits of subsidiaries. Undistributed profit means a subsidiary company has earned that profit, but subsidiary company has not distributed it through dividend. Now, please invest some time in this. I will take 5 to 10 minutes just to explain this adjustment, and then I'll give you a real life practical example. If you have not heard that example before, it will give you a good knowledge. Listen, this is P company and this is S company. Okay, this is P company and this is S company. Now listen. You know, have you ever seen the consolidated income statement? Yes, you all have seen consolidated income statement. In consolidated income statement, we book sales, we are adding together sales for everything. That means we record complete. Look at here. We record complete income of subsidiary company in our books. In consolidated income statement, we do adding together. That means we record complete profits of S company in our books. That means we treat subsidiary company incomes as our income, because in economic reality we control it, not because in economic reality we control it, right? So on the basis of that economic reality, we book complete income of S company now in our books. We book complete income, we book complete profits, we book complete profits of S company in our books. So now when we go to tax department, with this income statement, and we say tax department that we have booked this income. Case number one, listen, case number one, we have booked the profits of S company. Now we'll say to tax department, okay, take tax of this. So tax department will say, no, we don't want to charge any tax on your subsidiaries profits. We'll say why? So they will say, because our policy is we will only charge tax on you. We'll only charge tax from you whenever you will withdraw these profits in the form of dividends. Whenever you will withdraw these profits from your subsidiary in the form of dividends, then we'll charge. So in the case one, I say, okay, in future I will withdraw it as a dividends. In future I will withdraw these profits as a dividend. So yes, in this case, this is a taxable temporary difference. In this case, this is a taxable temporary difference. Why? Because we are booking the income of S company, because we are booking the profits of S company now, and tax department is saying that we'll be charging tax on these profits. We will be charging tax on these profits in future. We will be charging tax on these profits in future if you withdraw as a dividend. And we say, yes, we will take out dividends in future. So yes, it's a taxable TD now. It's a taxable TD. In this case, it's a taxable TD for sure, because you have booked income now, and on that income, tax department will charge tax in future. So yes, it's a taxable TD now, and you should book deferred tax liability in this case. This is the first event. Second event. Now parent company just book the profits of S company in their own books, like normal consolidation. And we go to tax department. Tax department will say, no, we don't want to charge any tax now. But if you withdraw in future these dividends, if you withdraw these profits in future in the form of dividends from S company, then yes, we'll charge. Then yes, we'll charge dividends from you. In that case, now what we replied, we said, no, we have no intentions to withdraw dividends from this subsidiary. We have no intention, and it is highly probable that we won't withdraw. So in this case, there is no taxable temporary difference. In this case, there is no taxable TD, because now in future there will be no more dividends. In future, we won't withdraw any dividends. And yes, we are the controlling party. Only we can decide about the dividends. No other party can decide. We have got the sole authority that whether to withdraw or not. And yes, we are saying that we won't withdraw. So in this case, it's a non-temporary difference. Now there is no temporary difference, because in future there is no tax. In future there is no tax. Now read this. P company has control over dividend policy of S company, but it is highly probable that P company won't withdraw dividends from this S company. In that case, there is no taxable TD. It's a non-temporary difference. It's a non-temporary difference. Now, I often say my student this tagline. See, read this tagline. Read this tagline. What is the tagline? You can, but you won't. You can, but you won't. You can, but yes, parent company can take out dividends. Parent company can take out dividends, but parent company won't. But parent company won't, but you won't. Why parent company won't take out dividends? Can anybody tell me? Can anybody tell me why parent company won't take out dividends from this subsidiary? Because there are some subsidiaries which we keep for growth purposes. We constantly reinvest our funds in that, and we want extreme growth. So in that case, we don't withdraw dividends. But last 6 to 7 years, I got a practical example for this line. Previously, I used to give different examples, like the way I said growth and all. But in 2015 or 2014, I got one very good real life example with the name of the country. And this is the example. Read it. Do you guys know where corporate America saves money? Corporate America saves money. Corporate America means big giants companies of America, USA. They saves money in Mexico. Mexico shares border with USA. We all know that. And in Mexico, if you compare United States and Mexico, in Mexico there is high crime rate, lot of drugs. Even you have seen that season Narcos, I think, on Netflix. It's about drugs and major Mexico. So in Mexico, corruption is also very high drugs usage, and a lot of these things. So that's why Mexico government has reduced the tax rate to 10% almost. Just for instance, just think the corporation tax rate in Mexico is 10%, but the corporation tax rate in America is 30 to 40%. For example, I don't know the exact number. In USA, the corporation tax rate is 40%, but in Mexico it's 10%. So what happens? All the big giants companies, they keep their subsidiaries in Mexico. All big giant companies of America, they keep their subsidiaries in Mexico in order to avoid tax, because in Mexico the tax rate is only 10%. So they earn whatever they earn, they accumulate in Mexico. They accumulate in Mexico because in Mexico the tax rate is only 10%. You're not getting. And they never withdraw their funds because they know if they withdraw their funds in the form of dividends, they will have a big tax in US. In US, they have to pay tax. In United States, they have to pay a big tax. Now what happens? Listen the end of the story. But when United States, US government realized that companies not bringing funds in US, so sometimes after many years, they give a tax holiday. They give a tax holiday for 1 year, that now, okay, if this year you will bring the funds in United States, we won't charge any tax. So in this way, they take the funds. So this is the ideal example. This is the ideal example that if you are a giant company in USA and you have a subsidiary in Mexico, so you won't withdraw dividends, because if you withdraw dividends, you will get a big hit of tax. Did you understand this example? Did you understand this example, my dear students? Yes, there is a possibility. One student is contributing I think he is saying the Bermuda. Yes, there are different other tax havens as well. There are different other, but for USA and Mexico shares border. Mexico is very near to USA. So if they open the subsidiaries, they can easily travel as well. There may be other reasons. Did you understand the example of Mexico and USA? Please reply on the chat box. And yes, this thing which I have taught you, this is a non-routine area, but yes, you should have this knowledge. Now, in the end, I would like to tell you guys that be active on the WhatsApp group, and I have already solved the latest past papers. The latest past paper means September, December 2021 past paper, which is available on internet. I have solved it, and that four webinar classes, that four webinar classes are very, very important. Four webinar classes are very important. Latest past paper. I have even discussed ICO. In one class, I have initial coin offering. I've discussed many criticism on IFRS 3 criticism. So those webinars are very important. It's in my LMS as well as on YouTube. I'll share the link as well. So be very active. Be very active in these days. Whatever update I'll get, I'll send you. And one thing more, please, those who are my registered student, keep sending me the scripts now. Keep sending me the scripts as well as solve the mock. Because if we don't mark your scripts, you won't understand what are your mistakes. So please don't take risk. You have last 20 days. You have last 20-25 days. If you work hard in these days, I gave you the example of that position holder girl who scored 75 marks. She studied last 1 month and she scored position. Then why can't you clear? I just want pass. In SBR level, pass is everything. If you score 50 marks, you are king. You are king. No other word for you. So 50 mark is nothing. Still now you can score 50 marks if you start from today. If you start from today, you can think, work smart, use your notes, make short notes. Do one thing also. If you get stuck in any question in the exam kit, make notes that this happened with me on that day, so that you don't repeat this mistake again. This is how this is how I used to study when I was a student, right? So stay in touch. And also some part of this, listen, you have to read one article that because of COVID pandemic, which IS may come because of the COVID pandemic. There is an article. I will also send you this, and this is also available. This is also available on accaglobal.com. So if you read this article, this is also useful. You will be able to predict. Which sort of questions may come nowadays, right? Okay. So stay in touch, and thank you for attending the class. Bye bye.